So it's a nice morning. We meet for a session of financial reporting. So we are going to talk about local independent branches. So to start with, we have to go through some theory that is specifically what branch means, what are the importance of branch accounting, how you are supposed to prepare some accounts, like now the current account, the head office current account and the branch current account. So these are some of the notes which I prepared for you guys, so which I will share later to the relevant WhatsApp group. So a branch is an extension of a business to a different geographical area in order to meet customer satisfaction. So if you have a head office in Nairobi, then you think of expanding your business. We have various areas now you can extend your business to. So if your business is a bigger, you can think of expanding to the cities of Kenya. Right now, even Nakuru is there as a city now. That's been inaugurated the other day. So you can go and open another branch in Nakuru. You can think of opening a branch in Mombasa. You can think of doing another branch in Kisumu. So that is how you will expand your geographical area where you operate in. So reasons or advantages of branch is all about to safeguard the cash and the inventory of the goods in the branches. Remember that the goods of the branch, they are from the head office, even if the head office transfers them at a profit. So obvious, for us to safeguard those goods in the branches, we have to do branch accounting to ensure proper control on the branches. Another advantage of doing a branch accounting is to compare the profitability of different branches. Remember that as the head office, you might be having many branches in Nairobi, in Kisumu, in Mombasa. So if you want to compare the profitability of these branches, you do branch accounting. And another thing is to evaluate the trend and the prospects of the branches. So how are they doing? So the trends and the prospects of the branches. So we are going to look about local independent branches. We call them autonomous branches. So if you can go to the syllabus, you can see a word autonomous under branches. So autonomous, they mean independent one. Independent one. So these are branches which maintain their own set of financial statements and books of accounts. So when you are independent as a branch, you maintain your own sets of financial statements. However, the head office plays an oversight role. So the head office plays an oversight role. That is to verify the operations of the independent branch. So to oversee. So even if we have said that the branch is what? The branch is independent, yes. So the head office will be playing an oversight role. That is to verify the operations of the independent branch. So to verify the operations of the independent branch, the head office will maintain an account known as the branch current account. So to verify, so for head office to verify the operations of the independent branch, the head office will maintain an account called the branch current account. Similarly, the branch will maintain account known as head office current account. So in an exam situation, you can be told to prepare these two current accounts, the branch current account and the head office current account. So the branch current account is maintained by the head office. Then the head office current account is maintained by the branch. So this is how they are maintained. This is how they are maintained. So the branch current account, the branch current account. So balance brought down on the debit side. You add the branch profit, expenses incurred by the head office on behalf of the branch, goods sent to branch, remittance by branch, you credit, cash in transit, you credit. So you can see how you prepare it. Then the balance, so the balance you will get in the branch current account, the balance which will be in the branch current account represents head office investment in the branch. So the balance in the branch current account represents the head office investment in the branch. So which means that the balance of the branch current account will be recorded as a non-current asset. It will be recorded as a non-current asset, recorded as a non-current asset in the statement of financial position. So we can say that recorded as a non-current asset. So recorded as a non-current asset in the statement of financial position. As I'll just use initial statement of financial position, statement of financial position of the head office. Statement of financial position of the head office. Then, what about the head office current account? We have said that the head office current account is maintained by the branch. So, and that is how you maintain it. Balance brought down on the credit side. Goods from head office. Expenses paid by the head office on behalf of the branch. You credit all of those. Then you debit loss for the year, purchase of PPO on behalf of the head office. Then the balance carried down. So the balance carried down here now represents the operating capital in the branch, and it will be recorded as equity under the statement of financial position of the branch. So you will come to understand how to prepare this more when I come to a question. So they have said that the balance in the head office current account represents the operating capital to the branch, and it therefore shown as equity component in the books of the branch. So when you are dealing with these two current accounts, that is the head office current account and the branch current account. So the two accounts are supposed to be, the balances are supposed to be equal and opposite to each other. Like now you can see the balance of the head office current account is on the debit side. So this balance here, balance carried down. And for the branch current account, the balance is on the credit side, this balance there. So those two balances are supposed to be equal and opposite to each other. The way they are opposite, and when you are doing your two current accounts, those balances are supposed to be equal. But now in some scenarios, they might not be equal. Why? Why can they not be equal? Maybe if there is cash in transit, goods in transit, and when there is inter-branch transfer. So that is what has been explained here. NB, the branch, the balance in the, not the branch, the balance in the head office current account represents the operating capital. So that's when we have talked about it. And the other one down here is all about the balance in the branch current account should be equal and opposite to the balance in the head office current account. As I have said, the two balances are supposed to be equal. However, there are circumstances when these two balances may not be equal. On which scenario? When they are cash in transit, when there are goods in transit, and when there is the inter-branch transfer. Inter-branch transfer. Then there's a concept of unrealized profit. The concept of unrealized profit. So this one is the same concept you know from the topic of group accounting. That today, if you are a parent, so I can explain it from the perspective of group accounting. Today, if you are a parent company and you have a subsidiary, as a parent, you sold goods to the subsidiary, or as a subsidiary, you sold goods to the parent. And these goods which were sold from either party, they were sold at a profit. But now the recipient of these goods, let's say if it's the parent who sold to the subsidiary. The parent, when he was selling, he realized the profit. He realized the profit. But now, under the subsidiary, by the end of the year, the subsidiary never resold all the goods which he had received from the parent. So it means that out of the goods which are unsold by the end of the year, there's unrealized profit inside those unsold goods. It's the same now here. You use the head office is the one which was selling goods to the branch, and the branch never resold all the stock. It never resold all the goods it received from the head office. So which means that obvious the profit of the head office will be overstated. The profit of the head office will be overstated by what the branch never realized, because this branch never resold all of these goods it received from the head office. So that is the concept of unrealized profit. So as they say here, it arises when goods sent to the branch at a profit remained unsold at the end of the financial period. This implies that the profit on goods remained unrealized and they should be eliminated. So preparations of final financial statements. So you are supposed to prepare, so the head office and the independent branch will prepare their own independent financial statement. So the head office will prepare its own statement, the branch will prepare its own statement. So at the end of the year, the head office now will prepare a combined financial statement. That is for both the head office and the branch. And this is the first statement, income statement. So income statements. So you start from sales, And what you need to know is that here, this column of head office is maintained at cost. The operations of these are maintained at cost. So these ones are maintained at cost plus profit. These ones are maintained at a cost plus a profit, because the goods sent to the branch, they are sent not only at cost, but inclusive of a profit. Then now the combined, which the head office would prepare for both the head office and the branch, would be maintained at cost. It would be maintained at cost. So you start from sales, then you talk about goods sent to the branch. This one means goods sent to the branch. Goods sent to the branch is the head office who sent, so you will only record it under the head office. So for sales, head office can make sales, branch can make sales. Then you get the total there. For goods sent to branch, I've said it's the head office who will send. So you record only under the head office. So those goods will be received later. They will be received later. So these goods from the head office, goods sent to the branch, they will be received later under the branch as goods from head office. This one here, of which these two are supposed to be equal. The two are supposed to be equal. But if they are not equal, maybe there was some goods which were on transit. Then you raise goods stored in transit to branch, so you get your net sales. We talk about cost of sales, that is opening inventory for both the head office and the branch. You talk about purchases. So for the purchases, head office and the branch, then goods from head office, I've talked about it. It's those goods which were sent by the head office. So it's now from the head office. They were goods sent to branch. So goods sent to branch, you see up there, we increased the head office sales. Then after that, we can raise obsolete goods, the goods which are destroyed, you subtract, so that up to that point, you get the cost of goods available for sale. Then you raise your closing inventory. Then you get your cost of sales. So cost of sales is B. So to get your gross profit, you would check A, net sales, minus B, that is cost of sales. Then after that, you raise your expenses. So the first expense you have to check is the unrealized profit, if it's there. Unrealized profit. So unrealized profit is based on the closing stock of the branch. Because now, if there's a closing stock of the branch, this here, if there will be a closing stock of the branch, it means that these goods were received from the head office at a profit, and the branch never sold all of them. So which means that head office had already realized the profit, but the branch never realized that profit with the head office realized. So that's why we need to determine the unrealized profit, unrealized profit on these goods, unrealized profit on these goods, which were unsold by the branch, which had been received from the head office. So which means that the head office's profit is overstated by what the branch never realized. That is why we always determine that. We determine that unrealized profit. So after determining the unrealized profit, we do what? We raise, we subtract it from the head office profit, because now the profit of the head office is overstated. The profit of the head office is overstated. Then other expenses is like admin expenses, distribution expenses. So after that, you get your net profit after deducting those expenses. Then finally, you have to transfer. After getting the net profit of the branch, this net profit of the branch must be transferred to the head office. They must be transferred to the head office. So you can see we have deducted here. We have deducted here this profit which is above, the profit which is above there. Then we have added it to the head office. So that is why you can see down there under the branch column, it's dash. So because we have transferred the branch profit. So this retained profit you get down here for the head office and for the combined column, they are supposed to be the same. Because head office statements are prepared by the head office itself, then the combined is prepared by the head office itself. That is fine. So we have a Moshi limited statement of financial position. So as a target, April 2017. So for the statement of financial position, this one is not that hard. So you start from your normal assets. It can be PPE. So PPE, you know that it's property, plant, and equipment. It contains all tangible long-term assets, but it's not a must that you combine them and name them as PPE. You can even name them individually. So the only point whereby we state them as PPE, to be more specific, is when we are doing published accounts. But on this scenario, I have just mentioned PPE to make the work easier because you know which assets are contained there. You can even accept to combine them, but it's not a must. You can just name them individually. Like now, if there's motor vehicle, if there's building, if there's furniture and fixtures, you just state them. Then another non-current asset is the branch current account. Is the branch current account. So the branch current account, I said, is prepared by the head office. And why am I recording it as a non-current asset? I said that the branch current account balance represents investment in the branch. So it represents investment. Who was making the investment? The head office. And you know that the investment is a non-current asset. So for the other assets, you know, like now inventory, receivables, cash, so bank balance, then maybe cash in transit. Cash in transit, it would matter where it was going. So if it was money sent from the head office to the branch, you record where it was supposed to be received, which is the branch. So if it was a cash from the branch to the head office and it was never received by the head office by the end of the year, remember that you need to adjust that cash in transit in the books of the recipient, which is the head office in that case. Then for the equities, ordinary share capital, retained earnings, you can see them. Then we talk about the head office current account. Again, I said the head office current account is recorded under the branch because it represents what? The operating capital. It represents operating capital in the branch. It represents operating capital in the branch. Then we have the current liabilities, which you can see payables there. So for this one, the workings is on how to determine closing inventory. So in a question of independent branches, that is to be more specific, local independent branches. When presenting your statement of financial position, you cannot be provided with closing stock. If you would be given closing stock, yes, that question is simple. That question is very simple. So how will you determine closing stock if it's not provided? How will you determine the closing stock if it will not be provided? So the main concern is on how to value closing inventory. The main concern is on how to value closing inventory. So closing inventory at the head office should be valued at cost as follows. So you start from opening inventory, you add purchases, you raise goods sent to branch, you raise some obsolete stock or spoiled, you raise your cost of sales. I will interpret this more when I do a question, but that is what you need to know in your mind for now. Because like now, you raise goods sent to branch. Obviously, goods sent to branch will reduce your goods in the head office. You raise obsolete. So if there's obsolete or spoiled, it will reduce your stock. You raise your cost of sales. Finally, you get your closing inventory for the head office. What about the closing inventory of the branch? So the closing inventory of the branch, you start from, you start from this scenario. So obvious opening stock, that is. So opening stock, you add goods from head office, at invoice price. Remember that they will be received at a cost plus profit. When goods are received from head office, they are received not just at cost plus, but they are received at a cost plus a profit. That is why you can see we are saying goods from head office, invoice price. You add purchases, you raise shortage in stock, and then you raise cost of sales. You raise the cost of sales, so that you get your closing stock. So for the combined, you take head office closing inventory, branch closing inventory, you raise unrealized profit in the branches closing inventory. And that's all for the introduction of, that is all for the introduction of branch accounting. And to be more specific, local independent branches. Local independent branches, or they call it autonomous branches. Autonomous branches. So now, to interpret more about this aspect of local independent branches, I would like to do a question of 2014. 2014. So this is a question of 2014, question 3. So to be specific, which sitting is this one? May 2014. I have never seen another local independent branch question other than this. So which means that if the examiner decides to set a local independent question, he will base most of his argument on this question. He might even bring this question. Like now, for foreign branches, it's only that they have removed it. Foreign branches are not there. So when they tested foreign branch, they tested a previous question in the previous periods. Remember that foreign branches was tested in the year 2018. So that question of 2018 was for 20. There's a period that question is 2012. It's a question of 2012. So but that one has been removed from your syllabus. It's not there. Foreign branches are not there. It's like now they CASNEP went ahead, or the stakeholders went ahead to say that maybe how many foreign branches are there from the Kenyan companies? Maybe there are few. So foreign branches was not of any importance. Maybe from that argument is when they removed the foreign branches. So branches is never taught anywhere again other than in section 3. You can never come across branch in any area. So once you are taught branch under financial reporting, you are done with it. Never expect it again anywhere. Maybe now you expect it in the practical world. So we are doing a question of May 2014, question 3. They say that Mosh Enterprises commenced the business on 1st April 2013. The head office of the firm is Nairobi with a branch in Mombasa. The branch is managed by a salaried manager. Mosh Enterprises acquires chocolates or plastic toys and they package them according to the customer orders. The packaging is a feature of the firm's marketing strategy and it costs 10% of the cost price of the toys. The toys are therefore sold at a profit of 12% of the selling price. The packaged toys are sent to Mombasa branch at a selling price, raised 6%. The foreign trial balance was extracted by the firm as at 31st March 2014. So we have the head office and we have the branch. So you can see we have capital fixtures in Nairobi, purchase of packaging material, purchase of toys, sales, goods sent to branch, expenses, trade receivable, trade payables, head office current account, branch office current account. We have the bank balance. Additional information. Package toys whose selling price to the PAPRI was 30.89 were dispatched by the head office to Mombasa branch on 28 March 2014 and were received on 5th April 2014. So what you can realize is that remember that our financial year ends on 31st March 2014. Our financial year ends on 31st March 2014. But we have some goods here, some goods which were being dispatched by the head office to Mombasa branch on 28, but they were received on 5th April. That is 5 days after the end of the year. That is when they were received. So which means that by end of the year, which is 31st March 2014, these goods were on transit. So that is why we always talk about goods in transit. Number 2, Mombasa branch had sent cash amounting to 50,000 to the head office on 30th March 2014. The cash was not received until 6th April 2014. So the cash was not received until 6th April 2014. Again, you understand that is a cash in transit because the cash was not received by the intended entity by the end of the year, but it was received after some days, which is 6th April 2014. Number 3, an annual stock take on 31st March 2014 refilled the following. Toys which cost the head office 10,000 were considered obsolete. So obsolete stock, of a stock of no value. Packaging material at the head office, which cost 5,000, was spoiled. The Mombasa branch stock take refilled a stock shortage of shillings 13,000, being the invoice price by the head office to the branch. Number 4, provision is to be made for a bonus to Mombasa branch manager at 10% of the net profit after the bonus. Fixtures are to be depreciated at 20% per annum on straight line basis. So you are required to do Moshi Enterprises head office, branch, and combined income statements. Then you are required again to do you are required to do Moshi Enterprises, head office, branch, and a combined statement of financial position as at 31st March 2014. As at the 31st March 2014. So let's start with the income statement, then we do the statement of financial position if time will allow. Because now I can see we have 1 hour, 13 minutes remaining. In an exam situation, that is enough to do this question complete. But now in this scenario, remember that we are practicing. You are training yourself on how to do it. So it can take an extra time. But in your exam situation, this question is supposed to be done within 40 minutes maximum. So we talk about income statement. So Moshi Enterprises. So income statement. So this is for the year. So our financial year was ending on 31st March. 31st March. 31st March 2014. So we have 31st March 2014. So we have the column of the head office, or we have the income statement of the head office. So we can talk about head office. I would say HO, head office. We can talk about the branch. And then we can talk about the combined. So the statement of the head office is maintained by the head office itself. The branch is maintained by the branch. And the combined now is prepared by the head office. Head office statement would be at cost. This one would be at the operations, the items of the head office would be at cost. This one would be at cost plus profit. A cost plus a profit. Then this one would be at cost. So we start from sales. We start from sales. So the sales of the head office was, the sales was 2.8. You can see there. And for the branch is 1.5. So if you add the two, so this one here, sales 2.8, 1.5. I think you can realize that this column is, so this one is for the head office and this one is for the branch. So we have debit, we have credit, we have debit, we have credit. So we have talked about this and this one. So then after that, we consider goods sent to branch. So goods sent to branch is this, goods sent to branch. But now before we go to the goods sent to the branch, 2.8 plus 1.5 is
4,300.
so 4.3. So that is 4.3. Then we talk about goods sent to branch. So goods sent to the branch, there is something here which you need to understand about the goods sent to the branch. So for the goods sent to the branch, goods sent to the branch. So goods sent to the branch is 1.5. But now the branch received 1.569. The goods which were sent to the branch is 1,598,000. But what is received in the branch is 1,569. Then under 40 shillings. So which is res? Head office sent 1.598. So 1598. But the branch received 1569, which is res. Why did he receive a res amount? So he received a res amount by 28,960. So there's a difference here of 28,960. There's a difference there of 28,960. So where is this difference? Where is this difference coming from? So this difference was coming from this aspect of the goods which were on transit, transit. And that one reminds me that there's something I need to interpret first before even we continue. And that is the main thing even you could have interpreted. So this aspect of percentages. So this aspect of percentages. So here, before you start a question of a local independent branch, take me clear, understand this. So this is what I could have started, which I ignored. So this is what you could have interpreted first. So there's this aspect of the way goods are sent to the branch and the way the sales are made, at what percentage. So they said that in this sentence here, Moshi Enterprises acquires chop rods of plastic toys and they package them according to the customer orders. The packaging is a feature of the firm's marketing strategy and it costs 10% of the cost price of the toys. The toys are therefore sold at a profit of 12% of the selling price. The toys are therefore sold at a profit of 12% of the selling price. Package toys are sent to Mombasa branch at a selling price less 6%. Toys are therefore sold. So, in short, you know that what you need to know is that selling price is equal to the cost plus profit. Cost plus profit. Then you need to determine at what percentage they make their sales. How they make their sales. And at the same time, how the head office transfers goods. How the head office transfers goods to branch. At what profit? So these two. So sales, it can be to third parties. So not the branch. So when they talk about selling price, like now here they said that the toys are therefore sold at a profit of 12% of the selling price. So when they say this, 12% of the selling price. So the selling price, when they say at selling price, you know that your selling price will be at 100%. Your selling price is at 100%. So they say that a profit of 12%. So which means that the cost is so the cost will be, it's 100 minus 12, which is 88%. So that is how they make sales. That is both the head office and the branch. Then the packaged toys are sent to Mombasa branch at a selling price, raise 6%, of which we have said the selling price is as the 100%. Raise 6%. So which means that you raise a profit of 6% at a selling price, less 6%. So our selling price on this scenario will be at 94% because we have deducted what? We have deducted the 6%, as they say, selling price less 6%. The selling price less 6%. So that profit will be at 6%. The profit is 6%. So which means that the cost will be 94 minus 6, that is 88%. It would be at 88%. So that is the major thing you need to do. on how the sales are made to third parties, at what percentage, 100%, because selling, it's based on selling price. Then on how the head office was transferring goods to the branch, as told again, as we have interpreted. So there's this goods sent to the branch. So of which we said that there's a difference of 28,960. So where was this difference coming from? The 28,960. So this 28,960 was coming from the aspect whereby there were some goods which were on transit. The goods which were on transit. Because if you go to addition information number 1, there were some goods which were of 30,809, which were being sold to the public, but they were being now dispatched from the head office to the branch, of which the branch never received them by the end of the year. So this is not one. Packaged goods, whose selling price to the public. And we know that goods are sent to the public at 100%. So first thing, you equate 3809. You equate 3809 with, you equate it with what? 100%. Because there were goods which were being sold to the public. Public is the third parties. It's not the branch. If it's goods sent to the branch, they are sent at 94%. So then they said, were dispatched by the head office to the Mombasa branch. So these goods were being sold to the public, but now they are being dispatched by the head office to the branch on 28 March, but they were received on 5th April. That is 5 days after the end of the year. So they were dispatched to the branch at 94. So you need to know at 94%, they would be of which value to the branch. So you take 94 times 308. That is 30809. You divide 100. You can see we are getting 28,960. This one. And that one was the difference on the goods sent. So it was just a confirmation. It's just a confirmation. So under the goods sent to the branch, we record the value of the goods sent to the branch as the head office. So the goods which were sent to the branch were at 1598. That is what we record under the head office. Under the head office, because now we will have to record that 1569,040 as a purchase when we will be talking about the cost of sales later. So up to this point, you have a net sales. You have net sales, and this one will be your A. This one will be your A. Then we talk about cost of sales. Talk about the cost of sales. So for the cost of sales, you start from the opening stock. You start from the opening stock. In this question, there was no opening stock. Even if you can check, there's nothing like opening stock. You talk about purchases. So there is 2 purchases under the head office from the trial balance. There was purchases for packaging material and the purchases for toys. This one. They are under the head office. There's nothing under the branch. There's nothing under the branch. You can see here. So this one and this one, you can add them and record as purchase. You can add them and record as purchase. So that one would be 4,440,000. So that is 4,440,000. Then after that, now I will record goods from head office. So that one now 1569,040. 1569,040. So the one which I just explained on this scenario, this one. These are the ones which were received from the head office. Then after that, before we subtract other items like closing stock, we have to check if there's anything affecting our stock. If there's anything affecting the stock, because now the stock we have for now is these the goods which have been purchased. So you go to your additional information number 3. So the annual stock take on 31st March 2014 revealed the following: toys which cost the head office 10,000 were considered obsolete. The toys which cost 10,000 were considered obsolete. Packaging material at the head office 5,000 was spoiled. The branch stock take refilled a stock shortage of 13,000 being invoice price by the head office to the branch. So in that scenario, we have obsolete, we have spoiled, and we have stock shortage. We have obsolete, spoiled. Obsolete stock, obviously, will reduce your stock. So the obsolete, 10,000. At the head office, that is what I'm recording at the head office and the combined. We have the spoiled at the head office, 5,000. And we have the stock shortage. So the stock shortage was at the branch, and it was at invoice price. And you know that invoice price from the head office to the branch, they said the 13 was at invoice price. It was at invoice price, which means that this is at cost plus profit. And it was an invoice price from the head office to the branch. And we know that goods are sent to the branch at 94%. Head office to the branch at 94%. So which means that we state that at 13,000 at 94%. But remember that for the combined column, we have to record it at cost, which is 88%. We have to record that at 88%, which is cost. So if you take 88 times 13,000, you divide 94. So you get 12,170. You get 12,177. So that is the cost. That is the cost. So up to that point, you can give me the totals. So 4,440,000 minus 10,000 minus 5,000. So this is 4425. Then 1569,040 minus 13,000. So that is 1556,040. Then the last one, 4440 minus 10,000 minus 5,000 minus 12,170. That is 44. 4412, 830. So I think that figures are correct from the members of the financial reporting. That figures are okay? So those figures, we call them cost of goods available for sale. So what we are getting there is cost of goods. Cost of goods available for sale. So then after that, now we raise the closing stock. We have to raise the closing stock. You deduct your closing stock. So for the closing stock, I said, if you find a question, you are given the closing stock, you are lucky. In that sitting, you are a lucky student. But now, if it's not given, we have to compute. We have to compute. So let me create another page whereby we have to do the closing stock. So when doing your closing stock here, it's just a matter of simple things. You know that cost of sales is equal to opening stock. I will use initials plus purchases minus the closing stock. Opening stock plus purchases minus closing stock. This is opening stock. This is closing stock. And here we have purchases. So we need to get closing stock. We need to get closing stock. So we make it the subject of the formula. So this one will move to the other side. It will be positive. Then this one will remain on this side, opening stock. So plus purchases will remain here. So then we have to deduct cost of sales. So we have to deduct the cost of sales, because now this one will go to the other side. So let's determine head office closing stock. So the head office column, you know that it's maintained at cost, and the cost is at 88% from the interpretation I did of these percentages here, of those percentages on that point. So we start from the aspect of opening stock. So there was no opening stock. Purchases, it was the one for packaging material and the purchase of toys. You remember the 4,440,000. Then after that, so the opening stock, we have the purchases. What reduced our purchases, our stock? There was some obsolete stock under note 3. There was some obsolete stock of 10,000. So this one reduced the goods you have. This was due to the stock take which was carried out during the year. We realized that we have some obsolete stock. There was some spoiled under the head office. There was some spoiled. That is not the 3, the 5,000. Then again, remember that we have to raise what we sent to the branch. Goods sent to branch. The goods sent to the branch, remember they were at 15 something, 1560 something, 1561. The goods which were sent to the branch. So the goods which were sent to the branch, 1598. So the 1598,000. So the 1598, this one. Remember that the goods are sent to the branch at 94. The goods are sent to the branch at 94%, as you can see from these percentages here. Head office transfer goods to the branch at 94. But remember that the head office statement is supposed to be maintained at cost. That is 88%. So you have to determine the answer there. So 88% times, so 88 times 1598, you divide 94. So I'm getting 1496. So that one you raise, because now these are the goods going to the branch. Goods which were going to the branch, their cost was 1496,000. Then finally, we have to raise now the closing stock. We have to raise the, not closing stock, but the cost of sales. We have to raise the cost of sales. Because we said here, we take opening stock plus purchases minus cost of sales. It's only that these items here, the 3, they affected our stock. So opening stock plus purchases, yes. But before we raise the cost of sales, there is some items here which affected our stock. Like now the obsolete, spoiled, and the goods which we sent to the branch. The goods which we sent to the branch. For the cost of sales, you use sales. Use sales. You consider your sales. And remember that sales is to the third parties. And sales to third parties is at 100%. At 100%, as interpreted from this percentage. So that percentage is very important. That is why I said that percentage is what you start by understanding when you are doing a question of this kind. So sales by the head office is 2.8. Sales by the head office is 2.8. You can see there, 2.8 sales. So this one is 2.8. So which means that we need at 88% because now the head office statement is maintained at cost. So you take 88 times 2.8, you divide 100. I'm getting 2464 from my calculator, 2464,000. So up to that point, you are done with this one. So what you do, you take your 4.4, you minus 10,000, you minus 5,000, you minus 1496, you minus 2464. So that is 465,000. So when I will be coming to record my closing stock for the dollars, that is what I will record. That is what I will record here. That is what I will record here. So the 465,000. So the 465,000. So let us do for the branch and we do for the combined. Let us do for the branch and the combined. So for the branch, again, you need to use the same concept of saying opening stock plus purchases minus a closing stock, of which you make your closing stock to be the subject of the formula. So for now, you know, we are using the same formula. So for the branch, remember that the branch, goods goes to the branch at 94%. Goods are sent to the branch at 94% from this scenario here. So goods are sent to the branch at 94%. So we start from opening stock. We start from the opening stock. There was no opening stock. So what about purchases? There was no purchases under the branch. But the only purchase we have is the goods from head office, the 1569,040. The goods from the head office. Goods from head office, the 1569,040. So this one here, goods sent to the branch, it was 1598, but the branch received 1569,040. The 1569,040. That is what you record there. Then before I deduct the cost of sales, there was some stock shortage under the branch. I think you remember there was some stock shortage of 13,000 due to the stock take, which was carried out during the year. So that one you deduct. That is according to this additional information number 3. You can see they said an annual stock take on 31st March 2014 refilled the following. So the Mombasa branch stock take refilled a stock shortage of 13,000, being the invoice priced by the head office to the branch. So it was an invoice priced by the head office to the branch, the 13,000. It was a stock shortage, which will reduce our goods. Then finally, you have to raise the cost of sales. So I said we use sales. Sales, we use the sales. So the sales under the branch, the sales under the branch is the sales under the branch, the sales of the branch So the sales of the branch is 1.5. So this one, sales. This one, under the branch, 1.5. So that one, remember that sales is made to the third parties. Sales generally, when they make sales, they made at 100%. So at 1.5. So what about now at 94? Because goods are sent to the branch at 94. What about 94%? So 94 times 1.5, you divide 100. So I can get 1410. So I'm getting 1410,000. So 1569,040 minus 13,000 minus 1410. So I'm getting 146,040. 146,040. So that is what I will record here. That is what I will record here. 146,040. So the 146,040. So what about the combined? Remember that you can't take this and add with this one. You cannot do that. You cannot add the two. But you have to do again another working. Another working. So another working we have to do here for the combined. So remember that the Adobe is 465,000. So which you know that combined is maintained by the Adobe's and it's supposed to be maintained at cost, which means that this one is maintained at 88%. And this 465 is okay. At 465,000 is at 88%, which is cost. But what about the branch? Remember the branch is at what percentage? 94%. The 146,040. So what about at 88%? That is what we need, the cost. So you take 88 times 146,040, you divide 94. So you get 136,718. So 136,718. Then, other than these two, there were goods which were on transit. Goods in transit. So remember the goods were being sent by the head office to the branch, but they were never received by the branch. They were never received by the branch by the end of the year. That is according to note 1. They were received on 5th April, which means that we never adjusted them under the branch. We never adjusted them under the Mombasa branch. They never affected our stock of the branch. So to cater for those goods, we have to adjust the stock of the combined. We have to adjust the stock of the combined. And we know that these goods, first, they were goods which were being sold to the public, as they say here, 3809, and they were being dispatched, by the office to the branch. So we have to do our working in a smart way, this way. So the first thing you have to determine is all about, remember that the 3809, they were being sent to the public. First, they were goods which were being sold to the public. We have to equate them at 94. To the public is not at 94, but 100. Sorry for that. They were being sold to the public. That is the first thing they said. But now they were being sent to the branch. So what about 94? I think we did this one and we got 28,960. 28,960. We did that. We did that one, we got 28,960. because they said the 30 to 9 first, they were goods which were being sold to the public. So that is why we equate them at 100, because we know sales to the third parties is at 100. So which means that now here, 28,960 is at 94. But for the combined, it's supposed to be maintained at cost, which is 88%, which is at 88%. 88 times 28,960, you divide 94. So I'm getting 27. So that is 28,960. 28,960 times 88. So 28,960 times 88, you divide 94. So that is 27,111. So if I take 465, so this one can be, I can say that if I say 0.5, because it's 27,111.4. So if I say 0.5, then it's like rounding off, this one would be 2, eh? So this one will be 2, because it will be 27,111.5. Eh? So it's the same as when I record in whole numbers, I avoid a point. So I can say 2 there. So 465 plus 136, 718 plus 27, 112. So I have 628, 830. 628, 830. So the 628, 830. So that is what we record here. So now we can be able to raise, we can be able to deduct that one so that we get the cost of goods sold. So the cost of goods sold, so 44.25 minus 465. So this is 39.60. Then 15.56.040 minus 146.040. So 15.56.040 minus 146.040. So this one I'm getting 14.10. Then the last one is 44.12. 830 minus 628, 830. So I'm getting 37.84. So this one was B. What you are getting here is B, the cost of goods sold. So that you get your gross profit, you say A minus B. So A is the net sales, this one. And this one was 4.3. So the first column was 2.8 plus 1598. So this one was 43.98. So take that one minus 39.60. So this one is 438,000. That one is 438,000. And if I take 1.5 minus 1410, so this one will be 90,000. Then the last one there, 4.3 minus 37.84. So this one will be 516,000. So once we are done up to that point, now we can raise expenses. We can be able to deduct the expenses. We can be able to deduct the expenses. So the first expense you have to check is something called unrealized profit on the closing stock. That is the first expense. So we can say here, we have a head office. So this is a new column. We have the branch. It's a continuation. It's a continuation. We have the branch, and we have the aspect of the combined. We have the combined. So I have said that raise expenses, of which the first expenses we have to deduct here, which we have to check, is on the unrealized profit. So this one I can record it a bit down here. It's on the unrealized profit. So unrealized profit will arise if there is a unsold goods by the branch, and these goods were received from the office. These goods which are here, the 146,040, you can see there's a closing stock. There's a closing stock of 146,040. 146,040. And these are the goods which were being received by the head office, from the head office at a profit. And we know that they are sold at 94% to the branch. So we need to know their cost. What about 88%? So that I will know the profit which is unrealized inside the 146,040. So if I take the computation of that, I will get 88 times 146,040. 88, you divide with 94. So I'm getting 136. So this is the cost. The cost of these goods will be 136,718. So the profit will be, so you minus the 146,040. So the difference is, because the total amount was 146,040 inclusive of the profit. So the cost we have 136,718. So if I take 146, if I take 146,040 minus the answer, I'm getting 93.22. That was the first unrealized profit. Another unrealized profit was on the goods on transit. Another unrealized profit would be on the goods on transit. Because the goods on transit were being sent, the goods on transit, they were just goods sent by the head office to the branch, but they were never received by the branch by the end of the year. So which means that the branch never resold them, because they were never even received by the branch by the end of the year. They were received on 5th April. You can check note 1. So these goods were of 3809. Yeah? But initially, these goods were being sold to the public first. So that is why I have to equate with 100%. You know that sales to the public is at 100%. So we need to know the way they were sent to the branch. Goods sent to the branch are sent at 94. So this one we did. I remember we got 28,960. We got 28,960. So now the 28,960, this one. So the 28,960, 28,960, this is the way they were sent to the branch at 94%, which is profit plus a cost. So we need to get the cost, 88% of these goods, so that I know the profit which is inside there. So 88 times 28,960, you divide 94. So we were getting something like 27,112. I think even this one we got somewhere. So To get your unrealized profit, remember that now we have to take 28,960, you minus the 27,112. So 28,960 minus 27,112. So I'm getting 1848. The 1848. So this is the second, and here is the profit. So the total will be, so you take the two. The total of the two you add, the one on closing stock and the one on the goods in transit. So 9322 plus 1848. So the unrealized profit will be 11,170. So why am I calling it unrealized profit? Remember these goods, this one were from the head office to the branch, but the branch never sold those goods. So remember that when the head office was selling these goods, the branch is sold at a profit, which is 93.20, the profit of 93.22. The way he was transferring these goods to the branch, the one which were on transit, obviously transferred them at a profit, which is now we have determined 1848. So this profit of 1848 and 93.22, remember that the head office already realized those profits. Head office had already realized those profits. It's only that the branch has not realized those profits because he has not resold those goods. So that is why we mean that the profit of the head office is overstated. The profit of the head office will be overstated by the total 11,170. That is why when I will come here to the expenses, my first expense will be the unrealized profit. My first expense will be the unrealized profit of 11,170 will be deducted under the head office profit only because the profit of the head office is the one which is overstated. Then remember that there was an obsolete goods under the stock take. Note 3. So those obsolete, other than they reduced our stock, remember that they are expenses to the entity. There was spoiled. There were goods which were spoiled. You remember that? And remember that there was some stock shortage. There was some shortage. Shortage was under the branch. There was some shortage under the branch. So this one, we reduced it to the cost. That is why we recorded at 12,170. Remember that the 13,000 was an invoice price from the head office to the branch, which is at 94%. But under the combined, we have to get at cost, which is 88%. So we said 13,000 is equals to 94%. What about 88%? That is why we got the 12,170. So other than the one we have recorded there as expenses, there are some expenses which are under the trial balance. We have some few expenses which are under the trial balance. And these expenses are just called expenses. They are just called expenses. They are just called expenses. So 400,000 for the head office. So the 400,000 for the head office, and we have the 40,000 for the branch. We have the 40,000 for the branch. So that is the total here we have for 40,000. We have the 440,000. So you can do the computations. So 438 we minus. So you know that I'm taking this gross profit from the other side here. The 438 I minus 11,170 minus 10,000 minus 5,000 minus 400,000. We're supposed to do this 438,000 minus 11,170 minus 10,000. So there's one expense which I have not recorded. There's one expense which I have not recorded. Anyway, we can record it, then we continue. There was under the additional information, there was something called depreciation on the assets. That is the one which we never recorded. This one, note 5. So note 5, we say that fixtures are to be depreciated at 20% on straight line. So we go to the trial balance, we check those fixtures. So fixtures are only in a lobby. So it would affect only the head office and the combined. So 20% of this, because it's on the straight line. Straight line is just on the cost direct. So 2 times 16, that is 32. So this one means that there's a depreciation here of 32,000. There's a depreciation there of 32,000. So it will be recorded under the total 32,000. So remember to fix that one there if you are writing. So as part of the expense, the 32,000. So we can continue. So now I can continue minus 5,000, minus 400,000, minus 32,000. So I can see we have a loss. Net profit or loss. There's a net loss of 2170. Then the second one was 90,000 minus 53. Because 13 plus 40 is 53. So this one will be 37,000. Then the last one will be 516,000 minus 10,000 minus 5,000 minus 12,170 minus 40,000 minus 32,000. That is 16,830. Then after you are done with the totals, those totals there, there's this aspect of a bonus. There's this aspect of bonus, which is given to the Mombasa branch manager. Mombasa branch manager. So they said that note 4, provision is to be made. Provision is to be made for a bonus to the Mombasa branch manager at a 10% of the net profit after the bonus. Very important, after the bonus. This one is the one which guides us here. So it's 10% of the net profit after the bonus. So which means that the profit we have here, the 37,000 is at 110. Because they said after the bonus. So it's inclusive of the 10%. So that one is inclusive of the 10%. So which means that 37,000 is inclusive of the 10%. So at 110%. What about the 10? What about this 10%? What about the 10%? So 10 times 37 divided by 110. So that is 3364. So the bonus would be 3364. So net profit after bonus. So the net profit after bonus here. So this one would mean to be a loss of 2170. So 37,000 minus 3364. So this one will be 33,636. Then the last one would be 16,830 minus 3364. So this one will be 13,466. So that after now we are done with everything, Remember that the profit of the branch must be transferred to the head office. Transfer. So the branch profit. I will just write in initials. Transfer the branch profit. So P means profit and B means branch. So transfer branch profit to head office, to HO. Transfer branch profit to head office. So which means that we will deduct the 33,636 here. Then it will be added under the head office. So 33,636. So the 33,636, it will be added under the head office. So which means that finally, down here, we will have a retained profit for the year of. So the retained earnings, retained earnings of. So this one would be nil. So this one would be 13,466. So what about the head office? So we take minus 2170 plus 33,636. 636. So you can see we are getting 13,466. So this first column and the last column must be the same, because the head office statement is prepared by the head office itself, and the combined statement is prepared by the head office. That is why you can see they are just in agreement. The 13,466 and the 13,466 for the head office and the combined. And that one marks the end of the income statement. The second part of the question was on how to prepare the statement of financial position. So for the statement of financial position, remember that it contains assets, liabilities, and capital. So we start from non-current assets. We start from the non-current assets. The non-current assets. So for the non-current assets, we have the aspect of fixtures in Nairobi. So fixtures in Nairobi. So under the head office, remember the head office was in Nairobi. So the fixtures in Nairobi are here. So the fixtures in Nairobi you were provided with under the trial balance. So this one, so the one where we charge depreciation. So the one which we charged depreciation. So this 160. So remember that the depreciation was on 20%. We got it at 2,000. So which means that to get the net book value, to record here, we have to take 160,000 minus the 32,000, the depreciation. So the 160,000 minus 32,000. So that is 128,000. So that is 128,000. So that is what we record here under the combined. Under the branch, there was no fixtures. So then another non-current asset is the branch current account. The branch current account. We say that the branch current account represents investments. It represents the balance in the branch current account, represents investment in the branch. By who? The head office. So that investment is a non-current asset. You know that an investment is a non-current asset. So that one will come to check later under the head office. So this one will be dash dash because it's an investment of the head office in the branch. So it will be recorded under the head office. Then we have the current assets. We have the current assets. We have the current assets. So the current assets, we start from inventory, the closing one. We did this one. We got 465,000. This one was 146,040. And the combined one was, so this one is what we did on the workings. For the combined one was closing stock 628, 830. So we have the 628, 830. You can check on the workings we did when determining the closing stock. Then we can come and talk about the receivables. We can talk about receivables. So for the receivables, so the receivables, the trade receivables is 280 for the Dovies and 150 for the branch. So 280 plus 150. 280 plus 150. So we have 430. We have the 430. Then after that, we have bank balance down there. We have the bank balance. So the 158 and so this 158 and the 62. 158 and the 62. So 158 and 62 is plus 62. So we have the 220,000. Then the other two things to record is goods in transit. There was goods in transit and cash in transit. So for the goods in transit, remember it was not one. Those goods were heading to the goods in transit were under additional information number 1. And those goods were being sent to the branch. So you adjust where they are heading to, where they are supposed to be received, where they are supposed to be received. So the goods to the branch, goods to the branch. So not one. First, they were goods to the public. Obvious, when you are talking about branch, you have to read in between the lines, because for you to know which, the way, not which, for you to know the way you are supposed to equate your figures with, at what percentages you are supposed to equate, you need to know these goods were from where to where. Initially, they were sold to where. So like now, note 1, you are told that packaged goods whose selling price to the public. And you know that from the analysis of the percentages on goods being sent to the branch and the sales, you know those percentages the way we did, whereby we said that when goods are sent to the branch, they are sent at 94%. When they make sales to third parties, they make at 100%. So that's why I always equate these 3809 with 100%, because these are the goods which were being sold to third parties, which is the public. But now later they were being sold to where? They were dispatched by the Dovies to the branch. And we know that to the branch, they are sold at 94. So then we ask yourself, what about 94? That is how we arrived at 28,960. The 28,960. That is the 28,960. So that is what I record here. They were going to the branch. But I will never record it under the combined, because already that adjustment has been done under the closing stock. That adjustment has been carried out under the closing stock, and that one can be notified from this scenario. When we were getting this 638, 628, that is 628, 830, the goods in transit were adjusted here. So we cannot do double work. We can't do double work. So for the cash in transit, it was heading to the Dovies, and that one there's no analysis you have to do. It's just recording the way it was being sent to the Dovies. The Mombasa branch sent cash amounting to 50,000 to the Dovies. The cash was not received until 6th April. That is why it was on transit, because it was never received by the end of the year. And it was from the branch to the Dovies. So we record under the Dovies. That is where it was supposed to be received. That is where it was supposed to be received. So the 50,000. And the combined, because now it has not been adjusted anywhere in the combined. Up to that point, we have total assets. We have the total assets. So after the total assets, we have to talk about capital and liabilities. Capital and the liabilities. So there was capital, and it was under the head office. And obviously, it would be under the head office because the head office is the one which is making the investments, even in the branch. Even in the branch. So capital, you can see it's under the head office, the 1 million. The 1 million. So the 1 million there. So then we have to add now the net profit. So the net profit was from the income statement we did. So the net profit we got, that is in short, the retained earnings down here. The 13, this one, 13,466. The 13,466. So the 13,466 and the 13,466 there. So we got the 13,466. That is fine. Then the next thing I said I record as equity is all about the head office current account. Because we said that the balance of the head office current account, the balance of the head office current account represents operating capital in the branch. That is why an operating capital in the branch, a capital is an equity item. So that's why it will appear here. It represents operating capital in the branch. So it will appear under the branch, and that one will be determined later. That one will be done later. Then after that, we can talk about liabilities. We can talk about some liabilities down here. So there was no non-current liabilities. There was no non-current, but there was current liabilities. So we have the payables. We have the payables. So the trade payables be the trade payables, where it is. So the trade payables 400,000 and the 40,000. So 400,000 and 40,000. It was just provided direct. So that one is for 40,000. Then there was a bonus, which is a provision. So we say the one which they were supposed to pay. So it was a bonus payable. It was a bonus payable. It was payable to the branch manager. It was 3364. 3364. So up to that point, we can say total equity and liabilities. Or capital, total capital and liabilities. So we can do a balancing of these statements. So we can start from the side of combined, because under the column of combined, there's nothing which is missing there. So we can start from the other column here. So we take 128,000 plus 628, 830 plus 430,000 plus 220,000 plus 50,000. So you can see there under my calculator is 1456, 830. So then 1,000,000 13,466 plus 40,000 plus 3364. 1,000,000. So this one was supposed to be for 40,000 because it's 400,000 plus 40,000. So for 40, so 1,000,000 plus 13,466 plus for 40,000 plus 3364. So you can see it's balancing. So the combined statement of financial position, it's balancing 1456, 830. Then after that, we can now move to the second statement, which is that of the branch. So under this column, under the assets, there's nothing which is missing here. So we can get the total 146,040 plus 150,000 plus 62,000 plus 28,960. So this one is 387,000. And this one is 387,000. So because if you have 387 here, it's supposed to be down here. So which means that we can get this. So you just take the difference. So minus 43,364. Because these two, 40,000 plus 3364. If I minus that, here is supposed to be 343,636. From the introduction, we said that the branch current account and the head office current account. The branch current account and the head office current account are supposed to be the same. Even if later I will come to prepare the current account, because in a question you might be asked about the current account, of which under the head office current account, under the head office books, not the head office current account, under the head office books, the head office will prepare branch. Head office will prepare branch current account. Head office will prepare that. Then under the branch books, the branch will prepare head office. The branch will prepare head office current account. Will prepare the head office current account. So before I move to that side, we can get it direct without even doing the workings, because I have said the balances from these two accounts are supposed to be the same and opposite to each other. So which means that under the branch current account, the balancing figure you will get here, it's supposed to be the same, which is down here under the head office current account. The 343,636. It's only here I have to raise the unrealized profit, 11,170, because the head office sold goods to the branch, but the branch never resold those goods. The branch never resold those goods. So the branch never realized the profit, with the head office realized. So that is why now the head office profit is overstated by 11,170. And you know that the head office prepares the branch current account to act as an oversight on the operations of the branch. So the 343,636 minus 11,170. So it would be 332. So this one would be 332,466. So now we can balance that column of the head office. In short, we can balance the statement of financial position of the head office. So 128,000 plus 332, 466 plus 465,000 plus 280,000 plus 158,000 plus 50,000. So that one is 14, 13, 466, this one. What about capital and liabilities? So 1 million plus 13, 466 plus 400,000. So you can see it's balancing. The 14, 13, 466. So let us confirm if this current account, the balances we have recorded, they are correct by doing the accounts. And in some questions, it can be a requirement. So head office books, we have said it prepares branch current account. Then branch books, it prepares the head office current account. So we go to the trial balance. So we check the head office. Head office is prepared by the branch. This head office account, head office current account is maintained by the branch. You can see when the balancing figure is on the credit side of the branch trial balance. So it's not, there's nothing here under the debit. So when I will go and record my head office current account, I will record my balancing figure. Not my balancing figure, my balance brought down on the credit side. 281,040 under the head office current account. Then the branch current account is maintained by the head office. So the balance brought down is under the debit side. The 360,000. The 360,000. So the balance brought down. The 360,000. We will debit the profit which was being transferred and the profit which was being transferred. The profit which was transferred, I think you can check from the income statement, was 33,636 and 33,636. Then you will come and talk about goods in transit. Remember that the goods in transit, they were heading to the goods which were on transit, they were heading to the branch. And the branch maintains head office current account. So once they will be received under the branch will debit inventory and the credit the head office current account, goods in transit. But remember that it will record them at 94%. We determined this was 28,960. Remember the goods were of 30,809. Those goods of 30,809 were being sold to the public at 100%. But now they are sent to the branch, which is supposed to be at 94%. That is where the 30,809 is coming from. So they debit inventory, they credit head office current account. Then for the cash in transit, note 2, the cash in transit was heading to the head office. So head office maintains branch current account. So once that money will be received by the head office will debit cash, then it will credit branch current account. And the amount was 50,000. The amount was 50,000. Let's look for the balances carried down. Let us look for the balances carried down. So 360,000 plus 33,636. So this one will be 393,636. And this one is 393,636 minus 50,000. So this one you can see the balance carried down here is 343,636. So what about the total down here? So 281 040 plus 33, 636 plus 28, 960. So this one would be 343, 636. So the balance carried down here would be the 343, 636. So that is what we meant. They are the same. The balances are the same and opposite to each other. And you can see that balance is the one which we recorded here. The 343, 636, even under the branch current account. But under the branch current account, it's only we deducted the unrealized profit. So that marks the end of the local independent branch with an illustration of the question of May 2014, question 3. So this is a very simple question if you can follow on how it's supposed to be done. And this is a block revision which is ongoing for the guys who can be interested to join. You can join on the coming classes. Like now we have another class on Sunday that is from 2 p.m. to 8 hours. That is, it can be even to 6. So whereby maybe I will be covering now the new topics that is concerning financial statement analysis. The financial statement. So when we talk about financial statement analysis, these are about the new topics which have been brought into financial reporting. That is what they call financial reporting and analysis. So the analysis on how to use ratios to analyze your statement and on how to use common size method to analyze your statements. Let us look at the common size a bit so that I think we can start from there next time. So when we talk about common size analysis is a method to compare financial statements of different companies of the same company over different periods. So you compare financial statement of different companies or of the same companies over different periods. So if it's the year 2020, the year 2019. So through common size analysis, standardized financial statements can be created, revealing the trends and providing insights into how the performance of different companies or one company compares. So the same technique can also be utilized in analyzing performance of one company for different accounting periods. The way I've said, you can use common size analysis under one company, but different periods in the year 2020, the year 2019, so that you check the performance of the company, for the different periods, for the different years. So to talk about this common size analysis, we have two methods to use: vertical common size and we have horizontal. So the vertical common size analysis, so in vertical common size analysis, each account in the financial statement, in the financial statement is expressed as a percentage of a base account. So the base account for statement of profit or loss, that is the income statement. The base account for the statement of profit and loss is the sales. So every account will be expressed on sales, and every item in the statement of financial, and every item in the statement of profit or loss is expressed as a percentage of sales. Is expressed as a percentage of sales. The way I've said, the base account for the statement of profit or loss is the sales or revenue. So every item in the statement of profit or loss is expressed as a percentage of the sales. Is expressed as a percentage of the sales. Is expressed as a percentage of the sales. So an analyst might be interested in evaluating changes in performance of the account of interest to sales over time as part of the analysis. So this type of analysis also allows an analyst to determine how the various components of the profit or loss account affect the company's profit. So right now, an example which is here, we can talk about this example. So whereby you are given an income statement, you are given an income statement. So when you are told to use common size analysis, the vertical one, the vertical common size analysis, so prepare a vertical common size statement. So you will be given an income statement of that kind. Then you will be told to prepare a vertical common size statement of profit or loss for the relevant entity, yeah? And discuss these profitability measures. So we said that under the profit or loss, the accounts are expressed on a certain base account, of which under vertical common size, it's expressed based on the revenues or sales. So revenue or sales will be our base account. So which means that to prepare the common size, like now down here, it's prepared this way. To prepare the common size, like now revenue will be our base account. So what about the cost of sales or cost of goods sold? The percentage will be, so you take the 86, 22, you divide by the base here, 21, the revenue, 21,796. So you multiply with 100%. You are getting which percentage? You are getting this 39.56. Is that okay? I think you are getting the 39.56 because the base here, or the base account, not the base here, the base account under the vertical common size statement of profit or loss is the revenue. So every account here will be expressed using the base account, which is the revenue. So you will be taking, if it's 88.22, you divide with the base account times 100%. The same for all the items. For all the items, selling price, you take 37.49, you divide 21,796. So all of those accounts. So that is how you prepare the vertical common size statement of profit or loss. So when you will come across that statement in an exam situation, never panic. You can see it's very simple. It's not about coming with the percentages, but you need to know that the base account under the vertical common size is revenue or sales. So every item will be expressed using that base account. So you take the relevant item, you divide with the amount in the base account times 100%. Then you can give a short explanation, like now the one which has been provided here, because now the main thing is all about to explain what effect these other items have on the bottom line. The bottom line is the net profit, the net income of 19.39. So we said that the gross profit as a percentage of sales is quite high. The gross profit is quite high. Why can it be quite high? Because the cost of goods sold was a bit low. So obvious makes your costs to be low so that your profit goes up. So the firm has a low cost of goods sold. That is the case. You can see they have said that, which is a characteristics of the industry in which Google was the relevant company, competes. So that is the first explanation you can give. So the gross profit, you can see it's more. The gross profit is more than the cost of goods sold. So your cost of goods sold needs to be a bit lower. So another explanation, you can see the operating profit. So the operating profit is all about the earning profit before interest and tax. So the operating profit of 30.43 is also in tandem with industry expectations. is in tandem with industry expectation. As there are not so many operating expenses, you need to minimize your expenses so that your operating profit can be a bit good. So there were not many operating expenses for the firm competing in this industry. So finally, net profit, we have 19.39 is also an indicator of high profitability of internet firms. For every dollar in sales, Google has a net income of 19.39. So mostly you talk about your gross profit, you are earning profit before interest and tax, and then you talk about the bottom line, which is the net profit, profit. You are done with the vertical common size analysis. You are done with the vertical common size analysis. You are done with the vertical common size analysis. So I think we can stop there for today because I don't want to cover everything. So the new topics are just simple. You can see, guys, we are even covering them, the financial statement analysis, because I find most of the students calling me and saying that, does you have notes including the analysis part? So the analysis part is not something which is wide. It's just two things on how to use common size to analyze statements and how to use ratios. Ratios you might be conversant because ratios is the same which you used in financial accounting. But maybe the common size analysis now is the one which is new. You can see I have covered the part of vertical common size analysis. So the part which might be remaining here of that common size analysis, the part which was remaining under the common size analysis is this horizontal, the horizontal common size analysis. So when you are using your horizontal common size analysis, again, you need to understand on how to do an income statement and at the same time on how to do the statement of financial position, the statement of financial position using this horizontal, using the horizontal common size analysis. So if you could like to attend these sessions, which are ongoing for the online classes, you are highly welcomed. My contact is always obvious on my page, which is 0728 760 546. So never miss to pass the financial reporting paper due to lack of awareness of the relevant training which you are supposed to do. And also in my YouTube account, there are videos. That is in my private account, there are many videos for all the other topics which are supposed to be covered in financial reporting, from group accounting, published accounts, cash flow statements. We have a branch, like now this one again I'm sharing. We have another topic concerning conversion of a partnership. We have farming. We have a professional account. Those are the main things, and all of them are covered. So if you could like to access the private YouTube videos in my account, again, you can contact me for the relevant arrangement. Have a good day and a good time as you continue with your revision.